All right. Next, Paul's asking, in your book in section 13.3, you mentioned risk management to protect against bear markets. And by that, it's not market timing, but you talk about strategically changing allocations. Okay, so what are your normal asset allocations and how do you adjust your target percentages as a part of that risk management process?
Okay. The what I'm recommending now is an upgrade from what I have in my book. I work a lot with a 55% stock portfolio. I've done some very recent research to indicate 65% works considerably better for the majority of retirees. So I would recommend a 65% stock, 30% bond, 5% cash portfolio. As far as adjusting that, the question is about adjusting that for what was the question? The question asked
For
about.
the idea of risk management, you talk about in the book
Okay.
that
Yep,
maybe
I
you'll
gotcha.
deviate from the asset allocation
Sure.
targeted at some
Risk
points.
management, which also has another name called tactical asset allocation, is an attempt to preserve capital by reducing equity allocation or increasing it depending upon one's perception of risk in the stock market. And I use a third party to do that. I just don't feel comfortable doing it myself. I get my emotions involved. You have a third party that's done this for years and done it well. It's great to have that advice and not be worried, that you're going to do something damaging to your portfolio.
How big of swings, maybe that's really what the question's getting at. Like if that service suggests maybe now's the time to have a lower stock allocation, how far are you deviating from your target?
Yeah,
Is
I
it just a
follow
few
their
percent?
recommendations myself personally, but their recommendations recommend a range from being 100% invested down to 0%. They got you down to 0% stocks in early October 1987 before the big crash. So they rode through that crash without any ill effects at all.
Okay, so you are willing to make big swings, it sounds like.
There are times where it could demand, yeah. And it's not just the reducing, it's very important. Like in April of 2009, it was very important at that scary time in the world to have a objective third party saying, hey, stocks are cheap. We got to load up now. Get that allocation up there. It's very important. The most instinct of individuals, including myself, was, well, I want to see if the world survives this crisis or not. Of course it does. If it doesn't, we have such bad problems, whatever else we talk about won't matter. So I think it's best to take a view that the world will survive.
Okay. There is another question on inflation, and I think we've probably really already touched upon it, but to emphasize the point
Okay.
again, I'll ask the question. So if inflation is a big problem, why not take the entire bond allocation and put it in TIPS? Doesn't this solve at least part of the problem?
You could do that, but then you're taking a pretty strong position about what inflation is going to be doing in the future. And I myself have no clue. So I'd rather follow a more diversified approach and include assets that may not be optimal at a particular time, but over the long run have done well.
Okay, it's the entire bond allocation, not, I don't think you meant the entire, like don't go 100% TIPS,
Yeah,
just
no,
for the
so
bond
I
piece.
would think that in that, yeah.
Okay. Okay, some other questions on some tax planning things, but I think that's really beyond our scope for today. Okay, this is relevant. So with the US economy expected to grow at low single digits and international emerging markets growing at higher rates, what are your thoughts about the percent of equities to place in international or US? And just as a lead into that, in the book with your baseline allocation, you would have 20% international, 80% US because of the 5-way division.
I
Okay.
know that funds like there's from a major mutual fund supplier, which has a global fund, and invests 37%, I believe, of its assets in international stocks and 63% domestic. That to me seems like a reasonable breakout, particularly in view of the fact that domestic stocks are really expensive and international stocks are at least relatively cheaper. So increasing your international exposure here to me makes sense.
Great. Next question. I found your inflation research fascinating. So continuing on that line, would not taking inflation adjustments in the first 5 years help mitigate the sequence of returns risks if starting at a higher than a safe max of 4.7%? So maybe mixing the level spending strategy with the COLA strategy and skip the COLA's cost of living adjustments in years 1 to 5. What do you think of that?
5.7%? Was that the rate they're taking out at? Or?
No. Yeah, it just if you're starting higher than the universal safe max of 4.7%.
That's a tough one for me to comment on because I don't know what will happen to those factors, inflation and returns over the next 5 years. So once again, that's taking a position to a certain extent, which may not be justified by what actually happened. So you have to be careful of that. I mean, it sounds to make sense on the surface, but I don't know what it'll look like 5 years from now.
Okay.
Want me to ask the next one?
Yeah.
We have one here. Your approach to safe max is historical worst case. Morningstar models safe withdrawal rates using forward capital market assumptions, and Karsten Yeski's safe withdrawal rate series uses the worst of both of those. Thoughts on each approach?
Well, I have a lot of respect for the folks at Morningstar. They've produced quality research. Christine Benz is first-class researcher. I don't necessarily agree with their conclusions. Perhaps it's a difference in our methodology. I'm using historical data versus they're using projected data. The question is, how can we be sure about what will happen in the future? How dire will it be? I agree that over the next 10 years, American stocks are probably going to return a lot less than 10% a year, maybe zero. So that...
I mean, couldn't someone say, again, just to play devil's advocate, well, how accurate do you think the historical stock returns are going to mimic, future returns, or the future returns, better said, are going to mimic what happened historically? Wouldn't it be better to take the current valuations and assess from there in a similar manner that you were speaking earlier about tactical allocations?
That's my methodology does that basically. It introduces the Shiller Cape, a measure of stock market valuation, and that's one of the two prime factors they determine your withdrawal rate. So I think you're right. It's covered by that.
Yeah, you're right. It is covered if you're getting to your initial number through that. Yeah, then it would be covered. You're just not messing around with the allocation to cover. I get it.
And maybe also anyone using the forward projections, which I've done that sort of thing as well. But that was a bigger issue maybe 5 years ago when interest rates were incredibly low. And now that interest rates have normalized, I think if you ask the Morningstar team what their estimates were today, they wouldn't be talking about 3% numbers anymore.
Mm-hmm.
But okay, the next question on rebalancing. What about the idea of leaving rebalancing alone until equities hit 65%? And maybe that's merging you talked about before. Your baseline strategy is 55% stocks, but maybe it'd be interesting to look at 65. What about, I guess, starting from 55, but not rebalancing until equities hit 65? I wonder how this would work, but rebalancing a taxable account generally does have a tax cost.
Well, the assumption there is that equity allocations will increase then over time. And then to extend something, they're proposing a variety of the rising equity glide path approach, which starts with a lower equity allocation and raises it during time. They're proposing something which basically it's not a conscious increase, something just rises out of market results. And that might work. Once again, I haven't run numbers on these things, so...
Yeah, some of these might just be more ideas of things to look at to see how that plays out.
Yeah, this field is full of surprises. I never make any assumptions about anything.
Okay, and well, right now we have a little pause in live questions. Please keep those coming in. We do still have some of the questions that came in advance, so I'll flip which list I'm using here for a minute. The next question, so why is the retirement planning community so hung up about the traditional drawdown paradigm in mapping out a successful retirement plan? and not focusing in on the paradigm of a guaranteed or variable income model, in which a lot of the uncertainty and volatility of the drawdown paradigm is reduced or erased. I'm seeing a trend in Generation Xers towards this type of planning. And maybe to just rephrase that in another way, it's kind of with what we talked about with retirement income styles. Like, why is there so much focus on just the investment portfolio? Is there, maybe the question for you, Bill, is like your thoughts on what about using annuities or bond ladders or other forms of protection as part of that distribution process as well?
From my perspective, I can answer that. Years ago, I defined my role as a researcher as trying to maximum the amount of withdrawals that can be taken safely from a retirement investment account without taking additional risk. So I didn't focus on anything else. But there's been plenty of work and papers published that indicate that having an annuity as part of your retirement income plan can be beneficial. And I know, Wade, you've done a lot of excellent work in this particular field. But I would give it serious consideration.
Okay, so yeah, it's not part of your research focus, but yeah, definitely you wouldn't dismiss it out of hand, it sounds like it. Okay, yeah, that helps. Another question. I believe Bill mentioned that the sequence of returns risk starts to reduce after the first 5 to 7 years. Does he think that this holds for, say, a 35-year retirement or a 40-year retirement? So maybe like the question's really, if the retirement length is longer, would you change that window where you have the most worry about sequence risk?
Yeah, I think the first 10 years of retirement are important to retirement no matter what the length of the planning horizon, because what happens in that first 10 years will compound the longest, the retirement. For example, if you have a bear market occurring in year 1, that's a serious problem. If you have one occurring in year 8, much less serious. So yeah, the sequence of returns risk does ameliorate over time. But you can't discount the possibility of something happening in the markets that's so outlandish that it might upset the apple cart. An example of that would be what happened in the late 60s when inflation started to rear up and lasted for over a decade. That was totally unexpected, I think, by most people. And who knows, we could have another financial crisis.
That sort of, since we're talking, that question was posed from the standpoint of market performance. And the fragile decade related to market performance of which you're taking a withdrawal rate. It would be interesting, and I'll pose that exact same question, but with inflation going out of control in the early years versus the later years. And I know the answer, but it's nice to hear it from you. Like, okay, consider the fragile decade, but replace stock market volatility with rampant inflation. How would they make would that affect, with the first 10 years of high inflation, proportionally affect more 40-year retirement versus a 30-year retirement, or vice versa, that kind of thing?
Absolutely. Yeah, because you're getting it right off the top. Your portfolio is taking a hit right off the top.
Okay. Another question that came in. So if someone was to retire today, does Bill still think the 4.7% universal safe max is appropriate given the high CAPE ratio, the cyclically adjusted price earnings?
Yeah, the 4.7% rule really doesn't take into consideration what market valuation is. It's a rule based on observation of one particular retiree out of 400 who in 1968 ran into a buzzsaw of back-to-back stock market declines and high inflation. So that I do think you need to take stock market valuation into account. I recommend in my book that a way to incorporate that. And today's environment, if you're looking at a 30-year withdrawal from a tax-deferred portfolio, I'd be looking closer to 5.5% rather than 4.7%.
Because inflation is also not currently high.
Yeah, for the time being anyway, yeah.
Okay, and there's another question. It has come up somewhat already, so maybe there's not much more to add, but to revisit this point, Bill mentioned on the podcast that he's done some preliminary analysis on safe withdrawal rates with higher equity allocations. Can he discuss more of his initial findings?
Yeah, I've been experimenting with 65% versus a 55% in my book. and I've run a scenario on it, tested against all 400 retirees, and in about 20% of the cases, particularly for those retirees who had a major bear market early in retirement, it doesn't work quite as well as a 55% allocation, but the differences are generally quite small. The reduction in safe withdrawal rate is small. For the other 80% of retirees, they get a pretty substantial bump in the withdrawal rate. So I think that it makes sense to use that 65% allocation and take defensive measures, risk management measures at times when the stock market looks risky. And then you'll have the best of both worlds.
Okay. Actually, questions are flying in now. That's
good.
I don't know if they're all, some of them may kind of be outside of the scope. Let me see if I can, some kind words coming in from Brett. So truly a great session. Thank you for putting this together. And thank you for your work and time and effort in publishing A Richer Retirement, as all of us walk the path. And here's another question. So I'm curious if Bill did any analysis on rising equity glide paths or other, I think now part 2, or otherwise using a longer time horizon, more around 40 to 45 years.
You're talking about rising equity glide path for the 40 to 45 year, or just two separate topics?
I interpret this as 2 separate topics.
Okay.
The answer is yes for both. You have looked at both of those. So I don't know if, yeah, maybe just a brief comment on the rising equity glide path idea and then also the longer time horizon.
Yeah, it just so happens this morning I started work on a 40-year retirement scenario with a tax advantage account. And hopefully within a week to 10 days, I'll have that posted to my website. You can see the results of that. Obviously, the withdrawal rates are going to be lower. But I'm definitely taking a look. I'd like to build a library on my website of scenarios that folks can choose, like a buffet, something that fits their particular needs.
Yeah, please share what that website is, because I think that will interest a lot of our listeners. You do talk about it quite a bit in the book. You can't put everything in the book, so
no, that's
the website
for sure.
you have a lot more space.
Yeah, it's www.bengenfs.com, and the FS is my old business financial services reference. So it's good. Also, if for some reason we run out of time to answer all the questions, I also have a feature on that website where you can click on Ask Bill and ask me a question. I'll do my best to answer it.
Yeah, I think you'll get some good research ideas from our listeners that way as well. Okay. Just trying to see, there are a few questions. Here's from John. So Bill said that capital market assumptions are taken into account with his CAPE adjustments, but SafeMax still predicts along the lines of opposite of past performance does not guarantee future results. Maybe what this question is asking is just
that aha.
Yeah, so the SafeMax as being based on historical data.
That's correct.
We always give the caveat past performance does not ensure future outcomes. If you just want to comment on that concern.
Yeah, sure. Well, it's a legitimate concern. We, at our own risk, do we extrapolate past results into the future? Because we don't know if few conditions can be much different. Unfortunately, there is no methodology I know that can escape from that conundrum, because no one can really predict the future. So if we do use it, we use it with our eyes wide open, that circumstances may arise which may invalidate it and force it to a whole new approach.
Okay, yeah, and another question coming in now. So there's now a bunch of questions on the rising equity glide path. Yeah. So everyone, Bill does discuss that in A Richer Retirement. So the first part of this question is just asking, have you looked at it? But I'll read the question. Recent research, including work by myself and Michael Kitze, suggests that a rising equity glide path in retirement may help mitigate sequence of returns risk. In your view, how compatible is this reverse glide path approach with the principles outlined in A Richer Retirement, especially for retirees who begin with a conservative allocation but want to safely increase their equity exposure?
Yeah, my conclusions I reached in my book, and I only analyzed one specific scenario. I think I started at something like 50 or 55% stocks and increased by 1% a year every year throughout retirement. And it did have a beneficial effect. It wasn't equally beneficial for all retirees. Some enjoyed more, some enjoyed less, but it worked, I believe, for just about every single retiree to start out with a lower equity allocation and let it increase over time. And I think you and Michael opined in your paper on that some years ago that it was the reason for that behavior is because you're avoiding the most serious effects of a major bear market early in retirement. If you have a very high allocation, you're going to get hit harder. If you start with a lower allocation, you have lower losses, and then you'll be increasing your allocation into a rising market, which is great.
Okay, yeah, and follow up on that. And yeah, I guess that's getting at this particular point. So, right, in your book, you looked at baseline 55% stocks. If you increase that to 85% stocks, your universal safe max actually increased to 4.8%. Right, and then the way we had looked at it in the article, and I think what these questions are also getting at is, what if you maybe went the other way? So instead of being 55% stocks throughout retirement, maybe kick down to, I don't want to go all the way to 25% for this scenario, but kick it down some and then work your way back up to 55% stocks. Have you also looked at that kind of direction for things, or might that be
that's essentially a rising equity glide path question, right? And I haven't looked. I've looked at allocations at 25%. If you keep them fixed, they're not good for your retirement withdrawal rate. But if you let it rise, it might work. I don't know. Once again, I need to run the numbers to have confidence in an answer about that question.
Okay, so yeah, that might be the future project is, instead of starting at 55 and going up from there, what about going less, but then working your way back up to 55?
It might work. I don't know until I actually run the numbers, and I plan to.
Okay. Do you see any other questions, Alex?
Well, but something I would ask, and we asked it in the podcast, but I'm curious now again, because all these questions about changing in allocations and all of that, and many times I'm kind of like, what's good enough, right? The greatest perfection is the enemy of good, that kind of quote. From an allocation perspective, I mean, is there a range that's fine, and you know what, you can call it a day and not get all worked up about? Is there, like, could you say, listen, if you're between an allocation of, I'm making this up now, 45% and 65%, you're good to go, for the most part, and you shouldn't get too worked up about it or lose sleep over it. That should get you around there. Is there kind of a range like that as well? Because I think people get caught up in this false sense of precision of 45% versus 43%.
Yeah, you don't want to cut it too fine. Once again, I'm recommending going higher to get a higher withdrawal rate without adding much risk at all. So, I'd be recommending a minimum of 65% in a retirement portfolio these days. Although,
you said minimum.
You may adjust that for tactical reasons right now.
You said minimum.
Yes, right. I'm going to study higher allocations,
Okay, so if anything, whatever equity glide path you choose, as long as if it was you, let's say if you started at 45%, whatever artificially low allocation you have, you'd want to end up at some point at 65%.
Or higher. Yeah, you might end up higher than that. Yeah.
Okay.
Okay. Another question that did come in, and I think it's back on this idea of like doing Monte Carlo simulations instead. So with historical data, we have a set number of observations. With Monte Carlo simulations, you could do 1 million test scenarios, and the worst case outcomes are always going to be worse if you start adding in lots of additional simulations. I guess the question's really getting at, like, what's your thoughts about making your numbers more in line with the worst case scenarios from a simulated approach, rather historical data versus Monte Carlo? Let's kind of put the question that way. What are your thoughts about Monte Carlo simulations in general?
If you're using Monte Carlo and you're using historic returns as a base to generate expected returns for that. I think that's fine. That should agree closely with what I'm doing. But if you project returns for stocks, let's say, which are much, much less than would normally expect for an extended period of time, you may achieve a lower withdrawal rate, significantly lower withdrawal rate. And whether that is accurate, I don't know. I can't predict the future. Who knows what will happen? But
okay, fair enough. I don't see any other questions right now, Alex. I mean, there's others that may be outside of the scope of today.
I've got one. I've got one for Bill.
Good.
Bill, do you favor the Adidas tracksuit that you have on over a Nike tracksuit?
I check my endorsement contract first. No,
I'm a Puma guy myself.
This is one of my favorite.
I got my pickleball titles right here, but I'm more of a Puma guy myself.
Yeah, when this wears out, I'm gonna be very sad.
You got to break out the cardigan soon for the winter.
Hey, you never know what comes next, right?
Maybe one more question, because I think it does. This question really gets at the heart of maybe some confusion about, in your new book, again, A Richer Retirement.
Thank you.
Supercharging the 4% rule. You're not really advocating for use of the so-called universal safe max of 4.7%. You're really talking about adjusting that based on the inflation environment as well as market valuations. That being said, let me just ask this question because it gives you a chance to really, I think, emphasize this point. So going back to the idea of adjusting the withdrawal rates when inflation is high or stock market performance is poor, it seems like that goes against the idea of basing one's withdrawal rate on the historical data, which suggests a 4.7% safe max. Your thoughts?
Well, I think we're talking about two different things. The 4.7% safe max is once again a worst case scenario. It represents an actual situation of a retiree who faced terrible bear market conditions, early retirement, terrible inflation. I don't see that happening in the near future. I think the stock market's going to be a difficult place, particularly the domestic stock market. But we may do well elsewhere. And over time, I think if you use, as I suggest, around a 5.5% rate, I think that incorporates enough bad news, otherwise you end up with too much money at the end of retirement and the regrets people often have with that.
Great. So to wrap things up, Tony, I'll just read what Tony wrote because I think it's a great summary of things. Thank you, Bill, for taking the time to answer our questions with such clarity. Your insights truly elevate the retirement conversation.
Well, it's very nice.
Tony's going to replace us.
I thank all the listeners for asking some very sharp questions.
All right. Yeah. Thank you, everyone, for joining us and for asking the questions. And again, if you would like to learn more, read further, it's A Richer Retirement by Bill Bengen, the father of the 4% rule, really the father of present-day financial planning-based retirement income. And also your website, bengenfs.com, for those who like to really dive in even deeper than the book goes. All right. Thanks, everyone, for listening. Thank you, Bill. Thank you, Alex. And we'll catch you next time on Retire with Style.
Thanks so much, Wade, for having me.